down the hammer and pick up the pencil. You're about to listen to the Savvy Radio Show. Learn from real-life real estate investors, experience revealed with the savvy landlord as your host.
Ladies and gentlemen, boys and girls, from around everywhere. I don't know, the internet, wherever you could hear my voice, that means you're outside of someplace, the world, I guess. I'm excited. Well, in the United States of America, we're having a calendar year here. December 31st, it's over. It's done. You missed the boat. It has left the harbor. And I have the superstar rock star Rose Taylor, a P3 accounting connoisseur, Redbud Advisors. This is a gal that I use, hire, and pay extra for tax planning services. So I asked her today, last minute, 10 days before the end of the year, to give us some tax strategies that we are missing as ignorant last minute real estate investors or regular investors that we forget every year. And I was running this list by Rose, and she added 1, 2, 3, 4 divorce, 5 things I did not understand. So further ado, please welcome Rose Taylor, tax strategist, enrolled agent, an accountant. How long have you been an accountant?
15, 16 years.
You don't know.
We don't
15,
like to.
you can't, I thought these accountants have to be precise.
Like
you can't write on a tax return 15, 16 depreciation.
You start putting numbers like that, then you start aging yourself. And
so you were 12 when you got your enrolled agent license at the. First of all, let's go in. No one knows what enrolled agent is. So let's just say that real fast so they understand your pedigree or whatever you are. What is an enrolled agent?
So an enrolled agent is someone that's federally authorized to represent taxpayers at all levels of the IRS.
Cool. So if I get an audit, I don't have to show up. I just call your team.
You can hire an enrolled agent to represent you. Yes. Enrolled agents they're continuing, their education is more tax-based instead of accounting-based. But before I was an enrolled agent, I was an accountant. So there's controller. There's, I don't know, you could have a whole podcast on that, but the different types of accounting roles.
Right. I learned that, like, I was hanging out with an investor this morning, and he looked dumbfounded when I said, you have managerial accounting. And, coming from the most uneducated person on the planet, when it comes to accounting, when I know something, I'm always dumbfounded that someone else doesn't know. Like, we have our books that's just internal. And then we have QuickBooks, which is more for the bank funding, and it's cleaner, or balance sheets. And so anyway, we definitely need to do a class on accounting.
Yeah. And sometimes, everyone learns differently too. So like I may tell you something, but then somebody else will tell you something that's the same, but they worded it differently. So you absorb it differently. If that makes sense.
I think the ultimate thing is creativity. I mean, most accountants on the planet are really not creative per se. They're black and white. And I think a successful accountant is somewhat creative. Like, hey, Rose, I want to buy this RV and I want to run it through my company. And you took a few minutes and you're like, I think we can do this legally, legitimately as a business expense if we run it as a business. And you said, these key things that changed my life. One, write the check out of the company. You cannot touch the vehicle at all. You must have a third party management of RVs. I was like, oh God, where am I going to find a manager of RV? This is where my slideness comes in of, creativity. And I actually did find a management of RV rental company called Dream Vacations, and on the south side of Oklahoma City, which was the craziest thing. And I ran that all legitimately. And I ran an RV rental business because of a few suggestions of a creative accountant. So that's the question.
I think it's important that, I have an entrepreneurship foundation. And then when you add accounting tax skills on top of that, that really allows someone to step into the shoes of a business owner too. Right. Because entrepreneurs, we have to be creative.
Right. And the goal for an entrepreneur is to solve problems. And when you solve problems, you get paid. So you should get paid. Like that's the goal here. All right, superstar.
Tax planning is something that takes place year round. It's not at the end of the year, like we are this, like you said, 10 days, right? So these are just real kind of quick, high level type of tax planning that you could take advantage of, or deductions.
Okay, hold on. You said something that's good. Hold on. So when is tax planning should be taken care of? Like, do I call you? You're like quarterly, 6 months, or every time I make a purchase? And am I bothering my accountant? Hey, I'm going to go buy a new truck. I mean, and then you're busy in the middle of tax season. Help us out here.
When it's tax time, like meaning it's February through April, that is not the time to plan for the past year. It's too late.
Yeah, I agree.
What tax planning is saying, hey, I'm thinking about doing X, Y, Z. What are the consequences of that? What is there any way I could do that better? For thinking ahead you should be planning right now for 2022.
Or also you should be I do it at the fourth quarter because look, hey, like I was looking at someone's finances the other day, a friend of mine, and he's like, he sold $500,000 worth of property. I'm like, hey man, did you allocate your tax burden?
Yeah.
That happens that's a lot. Forecasting what your bill is.
Yeah. That's especially when we work with real estate investors so much is, well, you sold this, or tax planning, I'm thinking about selling this property, or I'm thinking about doing an installment sale. What's the difference? Mm-hmm. How much tax liability are you really going to have? If it's not that, you may be in a 0% long-term gain, you just don't know unless you have that open conversation with your accountant throughout the year.
So you're going to get a lot of inquiries. So people should just email you if they're a client. Hey, I'm going to do this. This is what I'm thinking. And then you're going to shoot back a response. If it's real complicated, maybe set up a meeting. Other than that, you're just giving a quick 2-line entrance. Yes, you can do that. Because I send those to you all the time and you hate them. I'm like, hey, I bought an e-bike. I want to write this off. You're like, I'm following this law. This is your response.
I hate them. I mean, I just think that sometimes, I appreciate clients that ask their accountant before they instead of after the fact, like, oh, by the way, I did this. And I could have been like, wait a minute, you should have done it like this.
Right.
So
that's cool.
Okay.
All right, let's get into it. So what are the...
Here's one, and this is, some people don't like the way I say it. Some people don't like it, but stop billing your clients.
What do you mean by stop billing?
At the end of the year. So this is assuming that you're a cash basis business, which most small businesses are. Cash basis means that you record income when it's received.
Right.
So if you can, and you can push off invoicing those clients until January, that's something that you can do, because then it defers that income to the next year and you're not having to record that income in this year. That's a simple strategy. A lot of times it's used with like doctors or therapists or anyone that has recurring billing for clients, some business coaches.
Sure. You just push that gain almost.
You're pushing that income into the next tax year. Yeah. So, but, it's a good strategy if your taxable income is already more than what you want it to be for this current year.
And also on the opposite side, you making purchases at the end of the year to expenses, kind of?
Yes. Okay. So let's jump into that one.
Oh, okay. My bad.
I mean, these seem.
I should wrote these down.
These seem pretty simple, but it's always good to
refresh.
Yeah, refresh. There is an Irs Safe Harbor that allows you to deduct up to 12 months of expenses in the current year without question, without penalty by the IRS. So
it's called Safe Harbor.
Yeah, meaning that you can do it. They're not going to challenge it. So again, assuming that you are a cash basis business owner, if you have the cash, you can prepay your expenses. So let's say I'm paying you office rent. Okay. I could prepay that for 12 months.
Wow.
Now,
because you have the cash just building up in your account.
And I need the tax deduction.
And you can, oh, wow. So I've noticed that before. I never understood because I've never been that.
So on the flip side, and this is just as a courtesy, you might tell your landlord, hey, I'm going to pay you, and he needs to make sure that he cashes that check in the same year too. So it's a benefit to me as like someone paying rent, but it's going to be taxable to the landlord in that same year too.
Same year.
So, yeah.
But they don't have a good accountant like you. So,
but 12 months of rent or 12 months of subscriptions or anything like
that could be 12 G's.
Up.
That could be 10 G's.
Mm-hmm.
And then I can turn around and go buy something.
There you go.
It deducted out.
Exactly.
All right. So that's called safe harbor on your expenses. And that could be rent, not food that's perishable, right? I mean,
no, I'm thinking of just reoccurring expenses, stuff that you pay every single month, but you want to prepay it for the whole year.
Like utilities?
Insurance.
Oh,
a lot of times, yeah. Utility, rent,
I like the
utilities.
monthly on insurance, but I used to I don't know. I have a whole system. That's cool.
Yeah.
I really didn't. I need to take my boat to the safe harbor.
There's your fun fact.
Fun fact that I'm illiterate. Fun fact. Thank you very much. Thank you.
Then, so you had mentioned deductions, of course. Yes, you want to. If you need to buy any equipment for your office or printers, one example I always use, for me personally, December is usually when I upgrade my cell phone, because it's equipment. It's office equipment.
Cool.
The other thing are computers, office desks, things like that.
So you said, okay, is office equipment and office supplies the same thing? Like, are they categorized?
They would be separate. So equipment, I think of printers, computers.
Are those depreciated out?
You can expense them all in 1 year.
Cool.
Yeah. There's also
another question for another day. Okay.
Well, yeah. So, I mean, we had talked before about doing a podcast just on HSA. I'd love to do that.
Okay, we'll keep on rolling. So buy your stuff, because I know we only got 15 minutes. We only got 10 days left in the
vehicles. If you need to buy a vehicle, there's accelerated bonus depreciation in place for this year. So meaning that you could potentially write off 100% of that vehicle. The key is it needs to be in service before the 31st. So in service, meaning that you at least drive 1 mile.
Take possession.
Yeah, take possession. And it's in service.
And so why is it accelerated appreciation? It's a line item. Like, I bought a truck for 50,000 and I wrote that thing off.
Right. So there's certain rules for heavier vehicles. So like a vehicle, like a truck over 6,001 pounds. Yes, that could be eligible for 100% depreciation.
Wow.
Then if it's less than 6,000 pounds, it's maxed out at 18,200 for this year. 18,200. Mm-hmm.
So that could almost, now that can't be a personal vehicle. That's got to be a company vehicle.
Right. Mm-hmm.
But if you're a one-man band and you got a one-man car, right?
Yeah. So then that's where it gets a little tricky. You want to make sure that if you are using it for personal, then we only are allowed to deduct a certain percentage that's for business use. So or mileage, but it's either or. So if you're doing the mileage deduction, you don't get the write off the cost of the car. So when you get into vehicles in your business, I highly recommend talking to your accountant.
But it also is, as I've seen, audit friendly, because people manipulate this.
Oh yeah, not audit friendly. This is an area that's closely watched for.
Hey, I got a Range Rover and I make deliveries for Domino's. That ain't gonna work.
Yeah, and then if that's your only vehicle, you have to assume that there is personal use.
Okay,
it's your only vehicle.
I prefer mileage. That's just me though, because now my car is completely depreciated out because it's an old clunky clunk.
Yeah,
and I'm making money now. The government.
The other thing is when you write off your vehicle through your business, you have to recapture that vehicle when you sell it or trade it in. So it's like kind of a never-ending cycle.
And that's why people prefer leases, I would assume, so they can put the lease in the company's name, and then it's basically free on paper, but you never own it.
There's rules around leases too, but we can.
All right. Dang, another podcast. I'm done with these little mini podcasts. Let's move on. All right. What's the next one?
HSA, max it out. So
what's HSA mean?
Health savings account.
Health savings account.
Yeah. So if it's just for yourself, the maximum deduction is $3,600. If it's for your family, it's $7,200 for this year.
So you just basically write a check to an HSA account provider, custodial
and
per se.
And it's a tax deduction.
Off the business.
This is from your personal side.
Okay, cool.
So
I need to do that.
yeah.
Check.
And the great thing about the HSA is that most people, especially nowadays, do not have enough deductions to itemize. So meaning that they don't have enough medical expenses to itemize.
So it just sits there.
Well, you're not getting any write-off for your medical expenses. The example I like to use for me personally, I funded my HSA in full and then I paid for LASIK.
Or contacts.
Yes.
Or
but,
like I noticed even on Amazon, this qualifies for HSA. It's almost like a EBITDA account, like a food,
so you're able to write off your medical expenses without
aspirin. Yeah,
without
it qualified. It was even at Walmart. It said this qualifies for your HSA. I mean, like, wow, how detailed people can get.
There's all kinds of things. Sunscreen is a good example.
Dang. I'm so uneducated.
And the other thing is that it's not use it or lose it. So it just continues to accrue.
Can you borrow against it like an
yes.
IRA? Mm-hmm. And can it bear interest somehow? It can't bear interest. It can.
There are lots of strategies around the HSA, but yeah, you can borrow against it.
So I see you smile on that one. So
because I think that this is
not the scope. Okay. Yeah,
no,
but we will do an HSA. If anybody messages me or Rose and like, hey, I'm gonna be honest with you. I have an HSA account that Rose made me get like 5 years ago, and I've never put $1 in there because this is my weak philosophy. It just sits there. I can make that money work. Velocity. I can take that $1,000 or $5,000 and go make more. But I'm at a stage.
I just look at it as like if you know what your medical expenses, like for example, you know that you go to the dentist twice a year, or you know that you go to the chiropractor once a month.
Well, I didn't even think about my dentist.
Yeah.
Yeah, that cost me $60 a month.
Yeah,
for my family or something like that. That's $600, $800, $700, whatever. All right.
Okay.
HH Health Savings Account.
Next one is here's a kind of a fun one. So if you put an expense on your credit card,
okay,
your business credit card, that is a tax deduction in this year.
But it won't cycle until January.
No, it's a tax deduction for this year. If you're a cash basis business owner.
Okay, but you have to make that purchase in December.
Yes. Yeah, you have to make that purchase in December. But that becomes a deduction for your business in this tax year. So that the benefit out. There is you don't necessarily need the cash to get the deduction.
Oh, okay.
Here's what's important, because I know a lot of business owners, small business owners, commingle. The credit card needs to be in the business's name.
Yep.
If it's in your personal name, in order to get the deduction, the business needs to reimburse you. So that means the business needs the cash.
There needs to be a trail of paper trail.
But if you have a credit card in your business name and you need to buy stuff, but you don't have the cash for it, a credit card is a great option.
And then you can use your forwarding taxes or whatever to compensate that. Can I pay my HSA out of a credit card?
Most HSAs require to be funded from a bank account.
Yeah, I would assume. Yeah. But just that reads okay. How many more do you have of these? Is that it for this little?
I just have this one fun one, like not really fun. It's not fun at all.
Okay, because I have a random question. I saw your post and I wanted to ask you about it. You don't even know what I'm going to ask you. So go ahead. Tell us what you were going to say.
Well, I was just going to say, if you're planning on getting married or divorced, do it before
end the podcast. Rose, way to go, girl.
Do it before 12/31 because you get the benefit of the entire year. So if you're married on 12/31, you're married for the entire year.
Okay, if you're divorced on 12/31.
If you're divorced on 12/31, you're divorced for the entire year.
So, for 2021, I'm like, I'm gonna clip this deal. There. What do you guys accountants like get together and conspire these random ideas? This is boo-boo. All right, I hear you. All right. Okay. Okay. Here's another one. Okay, so let's talk about equipment. Is there a threshold to depreciate equipment? Is there a number like, hey, if I'm going to spend $5,000, I should depreciate it, or is it the quality of the product, or is it the industry? I was reading someone's financials, and their bookkeeper had $30,000 in equipment. And I was like, this is a weird classification. Are you depreciating this? And then after about 3 emails back and forth to this dude's accountant, they were all bundled together of his equipment that he needed to do these rehabs. So the question is, when do you depreciate equipment? Is it industry or the amount?
So it's a little bit of, it's the amount, and also if they need that deduction. Okay. So let's say if it benefits them, you don't have to take it all in 1 year. You could spread it out over 5 years.
Okay.
But I think for 2021, the maximum is like 500,000. It changes a little bit every year, but
I want to get into manufacturing because
that doesn't mean that
sounds so exciting.
That doesn't mean that you take that deduction if you don't have income to back it up either.
True. All right.
And we're talking strictly equipment and things like that. We're not talking
like
about
for manufacturing or
not talking about rental properties
but it's in a couple thousand, like, for example, as a landlord, like a snake, a $2,000 snake. I don't know if that would be beneficial there for them because they could just write it off as a cash.
Yeah,
expense.
they could just write that off. Yeah.
Okay, cool. That's just a question. I see that a lot on people's financials. For some reason, I coach people and they show me their financials, and I'm like, why is that so high? And then I dig into it and it's broken down. Mm-hmm. All right, so I'm good with my questions for now. We'll get back on the HSA on another day because we have to end this podcast because people need to get to work. I saw you post yesterday or the other day about cryptocurrency. Mm-hmm. And since this is the end of the year, what we're missing, is there anything that we're missing with cryptocurrency at the end of the year? Is there any advantages there? Should I transfer money? I don't have crypto, but I'm just saying, like, I saw you post something about it and I was like, this chick, what the heck? How do you know about this stuff?
I like to dabble.
You have clients with crypto? Huh?
Well, and it really, it's been around for years, but I think it's really taken a lot of people started playing in it in 2020, 2021. Mm-hmm. And crypto has been on the IRS's radar for several years. Every single year, we have to ask our clients, did you buy or sell any crypto? And they say yes or no. We have to mark that on their tax return.
Wow.
For 2021, this is an area that the IRS is looking at closely. And you're going to have to be reporting your gains and losses just like you do on stock with your crypto. So for those
just like my eBay account.
Yeah, for those that buy and sell, like they're day trading, you're going to want to track your gains and losses on that.
So then, just another side, because I have a friend that does crypto and he has traded some. So this is an extra piece of accounting that you have to pay for. It's not customary.
It's going to be another schedule on your tax return to reconcile. But what you don't want to get into is let's say you're using Coinbase or something and they report, oh, you sold $5,000 of Bitcoin. Mm-hmm. Okay, but is it also going to report the other side of how much you paid for that Bitcoin?
So you needed the conversation. So that's good. Hey, that's a great way to end this podcast. Hey, it's not too late to communicate. Not too late to communicate with your accountant. And especially if you even dabbled in crypto, let them know because they may classify you wrong on your tax return and not file the right documentation. And that will definitely lead to a no to a little piece of paper in the mail. I hate those envelopes from the IRS. I hate them when they say my full name and then they say my married name. I mean, my wife's in my name. They come in bulks.
The IRS has been behind for 2 years now, and it seems like they're starting to catch up. We're seeing a lot more letters.
Yes.
A lot more reconciliation from their 2020 tax returns. So, don't be afraid of any IRS letters. Just make sure you respond.
And let your accountant know, and then you might have to do a power of attorney.
There you go.
I just got that in the email from your team.
Words of wisdom is never assume that you're taking too many deductions.
Ooh, okay. That's another. Don't buy anything unless you get a deduction, and don't assume that you're not taking enough. Okay, one last one. Food.
That's all I have.
Dinner, food, deduction. What's, I was looking at this dude's finances. I'm like, damn, you 30,000 or some number on his financials that I was like,
well, I think I mentioned,
is there a number like if the guy makes, $300,000 a year, can he be a little robust on going out to dinner at Paseo Grill for $100 a meal? I mean, is there a number? Is there a flag?
No, there's not a number. There's not a flag, but I think that it needs, just like anything, it needs to be reasonable and it needs to be necessary. Ordinary and necessary is what the IRS likes to use.
Ordinary and necessary.
So to your business, it needs to be ordinary and necessary.
Damn right it is.
What's different? What's ordinary and necessary to one business owner may not be the same for the other business owner, especially if they're in different industries.
Or strip clubs.
Okay, here we go. They took away the entertainment deduction. Okay.
My goal is to ruffle every accountant's feathers. See if I can get them to smile.
Ruffle mine.
See if I can. I remember the one time you punked me.
One time.
Oh, I'm tired. All right, that's it, ladies and gentlemen, boys and girls. You heard from the superstar Rose Taylor, accountant, enrolled agent, p3accounting.com. They know what they're doing. They do my stuff. I appreciate them keeping me compliant, is what she says a lot. What's your little tagline that you tell me? Our job is what? To keep you compliant and out of jail.
Keep you compliant. Investor ready,
compliant, and audit ready. That's their tagline. P3. Anyway. Thanks for listening. If you have a question, if you want to know more about HSA, if you want to know more about Rose Taylor, go to p3accounting.com.
Thanks for listening to the Savvy Radio Show. Glide online and listen to our other motivating episodes at savvyradioshow.com. Connect on Twitter at LandlordBook and always be buying assets.